This question is adopted from Public Finance and Taxation, August 2023, question 3C. It is about taxation of employment income and other incomes of individuals. It is as follows. Solomon Chacha is employed as Managing Director of Otamu Millers Limited. During the year ended 31st December 2022, he presented the following information relating to his income. His basic salary was $120,000 per month, net of pay of $48,000 per month. He was provided with lunch by the employer from 1st August 2022 of $6,000 per month. He enjoyed a medical allowance from the company, which is only available to senior managers of $12,500. Now, this medical allowance is only available to senior management. That means the medical allowance is discriminatory. These are discriminatory medical benefit. And if the medical benefit is discriminatory, then it means it is taxable on the individuals who enjoy the benefit. In number 4, the company paid for him life insurance premium of $4,800 per month for each member of his family from 1st September 2022. This included himself, his wife, and the daughter. Those are 3 members of the family. Each is $4,800. So we shall multiply that by 4,800. In number 5, during the year, the employer paid a total of $200,000 as school fees for his daughter. This amount was allowed in the company's income statement. That means the company did not pay tax on this particular amount. And for school fees benefit, if the employer has not paid taxes on it, then the employee will pay tax. In number 6, he was provided with a fully furnished house with electricity and water. The employer paid monthly rent of $50,000 for the house and deducted 5% of his basic pay for the rent. That is called nominal rent. The cost of furniture was $240,000, while the electricity bill and water amounted to $1,800 and $1,000 per month, respectively. On 1st October 2022, the company provided him with the following: Land Cruiser, which was acquired at a cost of $3.2 million with an engine capacity of 3,000 cc. A house servant and a night watchman whose monthly salaries were $12,500 and $15,000 respectively. The fair market value agreed with the commissioner was $14,000 per month for each of them. He contributed 15% of his basic pay, monthly basic pay, towards a registered pension scheme, while the employer contributed 10% of his basic pay towards the same scheme. He has invested in real estate and from his rental houses, he reported a net rental income of $2.4 million after deducting the following. He deducted caretaker's wages, this is allowable. Fencing cost is allowable. Loan repayment, this loan repayment is allowed since it is like the loan principal is not allowed. What is allowed is the finance cost, which is the interest, but not the principal amount. Monthly rental income tax is also not allowed. Insurance, rent and rate, this is allowed expense, is a revenue expense. Advertising, we are assuming that this advertising expense is revenue and therefore allowable. Partitioning and CCTV cameras, these are capital expenditure and therefore not allowed because it's a capital expenditure. Repairs and maintenance is also allowable expense. In number 10, dividend received from United Millers Cooperative Society was 306,000 net. This dividend is from other cooperative societies which are not SACCOs and therefore is taxable. In other words, the dividend here from other cooperative societies other than SACCOs is non-qualifying dividend income. Non-qualifying. That means the tax collected at source is not final. The tax collected at the source was not final. Non-qualifying dividend income. And received interest from Fanaka Bank Limited, which was 240,000 net. This interest from Fanaka Bank Limited is qualifying interest income. Is qualifying interest income. In one of my videos, I've explained qualifying interest income and also qualifying dividend incomes, non-qualifying interest incomes, and non-qualifying dividend incomes. So you may want to look at that to understand more about the investment incomes in Kenya and their taxation. Right, allow me then to go direct to answer this question, which requires that we compute the total taxable income of Solomon Chacha for the year ended 31st December 2022 and tax payable, if any, from the income computed above. So we have Mr. Solomon Chacha. Statement of taxable income for 2022, for the year of tax of income 2022. Right. Now, let us begin with the basic pay or basic salary. The basic salary, basic pay or basic salary is equal to 120,000 multiplied by 12. 120,000 multiplied by 12. Now we're going to have 120,000 by 12 to be equal to 1,144,000. So we have 1,440,000. 1,440,000 is the amount. The next one is he was provided with the lunch by the employer. That lunch is 6,000 per month from 1st August. So that is the month of August, September, October, November, December, 5 months. Therefore, we're going to have lunch, but this lunch is benefit in kind. And for benefit in kind, the first 3,000, which is provided to the employee, is tax-free. But then any amount in excess of the 3,000 is taxable. Therefore, we have excess lunch or excess benefit in kind. So that excess benefit in kind, which is excess lunch, is equal to 6,000 minus 3,000 multiplied by the number of months from August to December is 5 months. And that is going to be equal to 15,000. Next, he enjoyed a medical benefit, medical allowance from the company, which is only applicable to senior staff. So this one here is discriminatory, and we say that where this is provided only to senior staff, then it is taxable on the senior staff who receive it. The amount was available to senior staff only, and the allowance is 12,500 per month. Therefore, we're going to calculate 12,000, this medical benefit, medical benefits is 12,500 multiplied by 12. And that is going to be equal to 150,000. So you enjoy the medical benefit of 150,000 per month, per year. We also told that the company paid for him life insurance premium of 4,800 per month for each member of his family, which are 3 members, himself, his wife, and the daughter. And that is from 1st September 2022. So that is the month of September, the month of October, the month of November, and December, 4 months. Therefore, we calculate life insurance or insurance premium. Life insurance premium is equal to 4,800 by 3 members by 3 months, by 4 months, by 4 months. And therefore we have 4,800 by 3 by 4 to be equal to 57,600. 57,600. Now, this life insurance is giving the employee a relief, which is known as insurance relief, and that is coming later after we have calculated tax. But for now, it is a benefit to the employee because the employer has paid for him. Being that the employer has paid for the employee, it's a benefit, but later the employee will enjoy a relief known as insurance relief, which is deducted from the tax payable. In number 5, during the year, the employer paid a total of 200,000 as school fees for his daughter. This was allowed in the company's income statement. That means the company did not pay tax on that particular benefit. And if the company has not paid tax on the benefit, the employer pays taxes on it. The employer has not paid taxes on the benefit, therefore the employee pays taxes on it. So that is education benefit. Education benefit is 200,000. Next is number 6. He was provided a fully furnished house with electricity and water. The employer paid monthly rent of 50,000. The rental benefit will come later for the house and deducted 5% of his basic pay as rent. The furniture cost was a total of 240,000, while electricity and water benefit is 1,800 and 1,000 respectively. Now we begin with the first item, which is furniture benefit. And furniture benefit usually equals to furniture benefits usually equal to 12% of the cost of furniture, which is 240,000. So we have 12% of 240,000. 12% of 240,000 is equal to 28,800. 28,800. That is per month, per annum. 12% per annum. Then electricity benefits, another one. And the electricity benefit is equal to the higher of, and we compare the two. CDT rate of this benefit, the Commissioner of Domestic Taxes rate of this benefit. Compare this with actual amount paid. The actual amount paid for electricity, we are told that per month, monthly electricity bill is 1,800 per month. That means per year is equal to 1,800 by 12. That is the annual cost. And that is equal to 21,600. That is the electricity benefit per year. Compare this with the CDT rate. Now, to understand the CDT rate, we have a document here for the rate of tax. And if you look at this document, electricity per month should be 1,500 according to the commissioner, and 18,000 per year according to the Commissioner of Domestic Taxes. So we compare the two and take the higher of the two. So here we have a total of 18,000. So we take the higher of the two, which is equal to 21,600. Next is water bill. And the water bill was 1,000 per month. We again take the higher of the two. Commissioner of Taxes, Domestic Taxes rate of this benefit is equal to 500 per month. 500 per month means 500 per month here means 6,000 per year. So we have 6,000 per year. Well, annual rate is 6,000. And actual amount was 1,000 per month. That means if 1,000 per month, then it means 12,000 per year. Again, we choose the higher of the two values. That means we're going to pick 12,000, which is the higher of the two. Right, so that is how to determine electricity benefit and the water benefit. So in the house that this employee was given, we have the housing benefit, we have the furniture benefit, we have the electricity benefit and the water benefit, which we have covered except for housing benefit, which will come later. It was provided with the following by the company. We have Land Cruiser, which was acquired at 3,200, 3.2 million. The engine capacity is 3,000 cc. Now let us take the motor vehicle benefit. The motor vehicle benefit is the higher of. One is the CDT rate of this benefit. Compare this with 24% of the cost. And the cost is 3.2 million. 3.2 million, 24% of 3.2 million. Compare with the CDT rate. Let us look at the CDT rate. So we are talking about a motor vehicle which is 3,000 cc. But when we are talking about Land Rovers and Land Cruisers, then we are going to take this last category, number 3. You can see this category of Land Rovers and Land Cruisers. Number 3, whereby Land Rovers and Land Cruisers is 86,400. So we're going to take that 86,400. So we have the CDT rate is 86,400, while the 24% of 3.2 million is equal to 768,000. So we take the higher of the two, which is 768,000. But then this one we multiply by whichever we choose, like we have chosen 768,000, multiply that 768,000 with the number of months, because it was provided with this motor vehicle from the month of October. That means October, November, and December. That is 3 months. So multiply whichever the amount we have chosen by 3 over 12. Because that is 3 months. So 3 over 12. 3 over 12. Therefore, we get here a total of 768,000 multiplied by 3 over 12 to be equal to 192,000. So the benefit is 192,000. The next bullet says that it was provided with the house servant and the night watchman whose monthly salary is 12,500 respectively and 15,000. The fair market value was agreed to be 14,000. Now, for the servants also, we compare, like for the watchman and also servant, house servant. So we have house servant and then we have watchman. Now for the house servant and for the watchman, we compare their monthly pay with the market rate, and we pick the higher of the two. For the house servants, if we compare the amount paid to the house servant is 12,500, compare with the market wage, which is 14,000, we take the market wage. So the market wage is 14,000. That is what we pick. And for the watchman, who is paid 15,000, we compare with the market wage is 14,000 and we pick 15,000, which is the actual. So the actual is 15,000. The market wage is 14,000. Take the higher of the two. So we have 15,000 here. And here we have 14,000. Compare those two. In number 8, he contributed 15,000 of his monthly basic pay towards the registered pension scheme, while the employer contributed 10% of his basic pay towards the same. This is pension contribution and pension benefit. Where he gets pension benefit from the employer, the pension benefit is not taxable, but whatever he has contributed to the pension scheme will be deductible. So when we come to the allowable deductions, we shall factor in that particular pension. He invested in real estate and from his rental houses, he reported a net rental income of 2.4 million after deducting the following expenses. Now, before we go to this other income, that is the rental income and also the dividend income, let us get all the employment benefits, then we use it to determine the housing benefit, because we have not added the housing benefit which he gets from this particular employment. Now we add all the other benefits. Now the total benefit, employment benefit before rental benefit, equals to 2,134,000. So we have 2,134,000. That is before the rental or the housing benefit. Then you go to the housing benefit. Housing benefit. And housing benefit is the higher of, the housing benefit is the higher of 1, the actual rent paid, which is equal to 50,000 by 12. That is 600,000. Compare this with 15% of the total employment benefit before the housing benefit, which is equal to 15% of 2,134,000, and that will give us a total of 320,100. So we have 320,100. Right, now we take the higher of the two, and the higher of the two is equal to 600,000. Having chosen 600,000, we need to subtract or less the nominal rent. Less nominal rent. And nominal rent, we were told that the nominal rent is collected by the employer, and that nominal rent collected by the employer is 5% of the basic pay of this employee. Therefore, we calculate 5%. The basic pay of the employee is 1,440,000. Now, 5% of 1,440,000 is equal to 72,000. Therefore, we deduct 72,000 from this rent which he has to pay. Now, if we deduct 72,000, the employee will pay or will get a rental benefit of 528,000. 528,000 is the rental benefit. Now, we can add all this and we call it total employment benefit. The total employment benefit is 2,662,000. Now, to the employment benefit, we are going to add other incomes of this individual. So this individual has other income such as the rental income, and also we have the investment income, which is from dividend. So we need to add all this, the rental income, before determining tax payable. Now let's go to the rental income. And the rental income is equal to 2.4 million. We were told here that he got 2.4 million from his rental houses. The rental income is 2.4 million after deducting the following expenses. So there are some expenses which are deducted against the rental income. And the expenses which are not allowable are supposed to be added back. They include the following. So we add back these allowable expenses. These are the ones which were not supposed to be subtracted. They were subtracted, but they were not supposed to be subtracted. They include fencing cost. This is not allowable because it is a capital expenditure. Fencing cost is capital expenditure, so not allowable. This one here, which is 640,000, should be added back. It was deducted, but should not be deducted because it is not allowable. So we subtract there, we add back their fencing cost, 640,000. Next is loan repayment. It's another disallowable expenditure. Just all the expenditure which you can see here, which are having star, are not allowable. Loan repayment, 320,000. Another expenditure which is not allowable is monthly rental income tax. Rental income tax, which is equal to 487,820. And then we have the last one, which is partitioning and CCTV cameras, which is also another capital expenditure. So partition and CCTV camera, that is equal to 222,000. Right, so all these are disallowable, therefore we need to add them back to the total income. Therefore, we are going to have the following. The total is therefore, the total rental income, which is taxable, is therefore 4,069,820. So we have 4,069,820. 4,069,820. That is the taxable rental income. Now to this, we now look at the investment income, whereby we have two investment incomes. But as we had discussed before, this one from Fanaka Bank Limited, which was interest, is qualifying interest income, and therefore the withholding tax was final. But dividend received from United Millers Cooperative Society is non-qualifying. Therefore, we need to gross it up because the amount was net. Gross it up and then add it for tax purposes. So we have dividend from United Millers Cooperative. So dividend from United Millers Cooperative, we need to gross it up. And to gross it up, here we are told that the amount was net. That means that amount is after deducting tax. And the withholding tax on this dividend is 15%, which is not final. That means the net amount is 85%. So we have 100%, then we have 15%, then we have 85%. 100% is the gross amount. 15% is withholding tax. That means the net amount which was received is 85%. This is the net amount. 15% is the withholding tax. 100% is the gross. Now, the amount which we are given here is 306,000 is the net amount, which is 85%. Now, to gross it up, we are going to calculate, or we are going to multiply 306,000 by 100% divide by 85%. Now, if we calculate that, we're going to have 360,000 is the total. The gross amount is 360,000, which we add. Now, until this point, we have put together all the incomes, and we are therefore required to determine total incomes. Total incomes, which will be the total pensionable income. So we determine the pensionable income. Now, the pensionable income is now equal to 7,091,820. 91,820. That is known as pensionable income. Pensionable income. From the pensionable income, we are supposed to deduct allowable expenses. Now, less allowable expenses. Until December 2022, or until the month of June 2023, there have been 3 allowable expenses. Though by now there are remaining 2 allowable expenses, but that will begin in the year 2024. Currently, we are still talking about the 3 allowable expenses. One of the allowable expenses is what's called pension deduction or pension deduction. Another one is owner-occupier mortgage interest, and another one is contribution to a registered homeownership savings plan. There are those 3. However, in this question, we only have one, which is pension contribution. Therefore, we less allowable expenses, one being pension contribution. And pension contribution is the lower of or the lesser of. Number 1 is 30% of the pensionable income, which is equal to 7,091,820. 2, we have actual pension, and the actual pension here, we were told that he contributes the employee contributes 15% of his monthly basic pay. So 15% of his monthly basic pay is equal to 15% of 1,440,000. So 15% of 1,440,000. That one is equal to that is equal to 216,000. Uh, 30% of pensionable income is equal to 2,127,546. Lastly, we compare this with CDT rate of pension deduction, which is equal to 240,000. Comparing the three, we take the lower of the three, which is 216,000. That is the actual pension contributed by this employee. That is what we deduct, 216,000. Now we have 7 million. We have 7,091,000. We have 7,091,820 minus 216,000. And that will become 6,875,820. 6,875,820. That is known as the taxable income. Question number 2 is asking that we determine the tax payable, if any, from the income above. And to answer this question, we are going to base the solution on the tax table for the year 2022, which is beginning from the year 2021, 2022. The tax table in the year 2022 is as follows. As you can see here, this is the tax table for the year 2022. The first 288,000 is charged at 10%. The next 100,000 is charged at 25%. And anything above 388,000 is charged at 30%. That is the tax table that we're going to use to answer this question. Therefore, we begin as follows. The first 288,000 multiplied by 10%. The next 100,000 multiplied by 25%. Then anything above 388,000 now we multiply by 30%. Therefore, we're going to have 6,875,820 minus 388,000. Multiply this by 30%. Now we have 28,800, 25,000. The next one here, which is equal to 6,875,820 minus 388,000. This one, if we multiply by 30%, we have 1,948,000, 946,000, 1,946,346. Now this, if we add all this, then we get the gross tax liability, we get the gross tax liability as 2,146,000. 2,146,000. 2,146,000. This is known as gross tax liability. From this gross liability, we need to less personal relief, and personal relief usually is 28,800. Subtract that one. Also less insurance relief, insurance relief is usually the lower of. So insurance relief is the lower of 15% of the insurance premium. And the insurance premium that we calculated, which the employer paid for this employee, the insurance premium was equal to 57,600, which is here. See it here, 7,600 for the insurance premium. So we calculate 15% of that, 57,600. Compare it with maximum, CDT maximum. The CDT maximum is 60,000. However, for this particular employee, he was paid for only 3 months. For these 3 months. For this employee, he was paid for insurance premium. He was paid for insurance premium from the month of September. So we have September, October, November, December. So that is 4 months. The employer paid for him insurance premium for only 4 months. So we take 5,000 by 4 months, and that is going to give us 20,000. A month is 5,000, the CDT maximum. But the actual, which is 15% of the insurance premium, is equal to 8640. So we take the higher of the two, which is going to be equal to 8640. That is what we subtract. Again, we subtract the pay as you earn, the payee. Pay as you earn, from this question, the pay as you earn, we were told that the pay as you earn is 48,000 per month. So deduct 48,000 per month also from this particular question. So we have pay which is equal to 48,000 multiplied by 12. And 48,000 multiplied by 12 is equal to 576,000. 576,000. Now, from the gross tax liability, if you subtract all those, then you're going to get that is giving us a total of 1,386,706. Now, this 1,386,706 is known as tax payable. This is now tax which he has not paid and is supposed to pay. So the tax payable now is equal to 1,386,706. And that is the answer to this particular question.